I know you're probably not familiar with the ins and outs of retirement plans, but they're very complicated. Lots of things to do. And when an individual plan, or in the case of Life Associates, a administrator of many plans, wants to do something that's unusual, and I'll talk more about what that means in a second here, wants to do something, then it's routine that you go through a process called VCP. It's just an application process. It's totally voluntary, to go to the IRS and say, hey, we got this problem, and we want to fix it, and we want the IRS's blessing. Now, it's not something that Life Associates or any plan sponsor has to do, but it's important to you as a participant, because if 2 years or 5 years down the road somebody says, or even 6 months, I guess, somebody says, gosh, this thing was done to my plan, or this correction was done, or a change was done, and what assurance do we have that this is proper and that my retirement plan remains qualified? And what I mean by qualified, you have money in your account that's deposited, and it earns, hopefully, income each year. You don't have to report that until such time as you actually physically withdraw it into your pocket, or, and so forth. So that's what's called a qualified plan. It's a separate trust, and it's not taxable to you along with your salary and so forth. So qualification is a term of art in the tax code that basically says, okay, as long as the plan does this, that, and the other thing, then it's qualified and the employees are deferred in taxation until some later time. So that's obviously very important to you as a participant, because if a plan is disqualified, then it's immediately taxable to you. And clearly that's something that any plan sponsor wants to avoid, and certainly the bankruptcy trustee, as basically running and Life Associates, wanted to avoid. So it was filed in 2014 by Bankruptcy Counsel. Obviously, here we are now, almost 3 years to the day, almost 1 month short to when it was filed. It took this long to come to some conclusion. So what we're going to do here is we're going to take about probably 30 minutes and maybe even less in terms of my talking, and then, of course, take questions, but just trying to bring you as a participant up to stuff in terms of what's happening and what you can expect to see. So next slide, Trey. And by the way, you can submit questions, as Trey mentioned, anytime. We may address them as we go along here, but if we don't, please be aware that we will certainly address all of them here at the end. And I just have a few slides here to go through. As I have been visiting with a number of housing authority participants, I've used the checkbook analogy just to give you a general idea of what's been going on this VCP issue. And I'm assuming that most of you, if don't currently, have had a checking account. And of course, you have a check register, the little thing you carry in your pocket along with your checks. And of course, you get a statement from the bank. Now, most of us balance our checkbook every month, but let's assume that you don't do that for a while. So now you're going to look at your check register, and your check register says there's $100 in there. That's what you think you have in the bank. But then, and you haven't reconciled your account for some time now, you look at your bank statement and there's only $99, okay? Obviously there's a problem. But that, in a nutshell, is exactly what happened with Life Associates over a period of years. They didn't balance their checkbook. Now, when I say the checkbook, your plan assets, okay? So in other words, if you don't balance your checkbook for, say, 6 months or 6 years or whatever the case may be, and then you try to do that and there's a penny off here or $1 off there, it's hard to find. It's hard to find. And that's, in effect, what has happened, is that there were thousands and thousands of transactions, deposits, purchases, sales, and so forth, that were very minusculely off. And over a collection of time, over a period of time, this separated, or there became a gap between what the record-keeping system, and we use Relias, this is a term of art to call it, that's our checkbook register called Relias, and the actual amount of money that was collectively then in all the plans. In other words, your statements were overstated. Not by a lot, about 1%. So again, if we're looking at a $100 account balance, it's about $1, but it's still off. And something in our business, what's called daily record keeping, that's what your plan, it's a daily plan, you can access it 24/7. We balance our books every day to the penny, because if you don't do it and you don't balance your checkbook for a while, then it's really, really, really hard to find. And clearly, when you're dealing with other people's money, you want to be sure and accurate and so forth. Life associates for a period of time, over a number of years, prior to the bankruptcy, did not do that, and then in the process of reviewing the books, auditing the books of the bankruptcy, that's when they discovered this. Okay, so here's what's in general happening, without getting too much into the weeds, and again, we're sorry that you have to go through all this. If we assume for the moment, you look at your statement and there's $100 in it, okay, there's really not $100 of money to back it up. There's only $99. And again, forgive me on the math here. Don't quote me on the math, rather. I'm just trying to give you an analogy and so forth. So basically, your statement has a little more dollar value in it than there is money to back that up. And so the correction to the IRS that the IRS approved, was applied for and approved by the IRS finally, was a two-part adjustment. And part of this is going to involve your own account. Now, some of you on the line have both a 401A plan, the money in which is put in by your employer, and some of you have a 457B plan in addition to that where you put your own personal money. So it doesn't matter if you have one or two, the adjustment that I'm going to talk about here in a moment applies to both. What's going to happen when you get your statement is that for the fourth quarter, and you may have gotten it, we've already sent them out here in January, you're going to see a negative amount, which is going to look like a fee, but it's going to say VCP, and again, that means Voluntary Compliance Program, VCP adjustment. So it's a negative number, and then again, that's truly unfortunate that part of this fix, if you will, has to be done that way. Now, that's already been done, because it's going to come out on your statement, and they're now working with, on the employer side, because there's also a fix from the employer side, but again, you will not see that on your statement because the employer will be doing that in the background. So again, this is going to get done here, and there's going to be actually benefits by getting through this whole process, but again, I wanted to explain as much as I could here to keep you fully informed. Next slide, please, Trey. Now, again, some of you, if you don't have a 457B plan, don't worry about this. You can ignore this for the next couple of minutes and so forth, but I just wanted to explain that in the case of 457B plans, that's all employee money. Okay, and so that's going to involve a mandatory deposit by your employer, and again, don't worry about that to make up that other piece that of the adjustment, if you will, and so forth. And in the 401, it's voluntary. Now, again, don't worry about the differences there, but I just simply, in the interest of full disclosure, is just to explain that the IRS is treating the 457B slightly different than the 401A because the 457B is employee money and the 401A is all employer money. Now, we've already gotten some questions, and in fact, when I've been talking to the housing authorities in recent weeks, I wanted to mention very briefly this third box here that talks about a check sent for the bankruptcy estate. It is simply a coincidence that the estate is winding down and has been winding down here and is probably closed by now, but has been winding down right at the same time as this VCP letter was negotiated with the IRS, okay? And again, imagine in any bankruptcy estate that you might be involved in which you're a creditor, and again, your retirement plan was listed as a creditor to the bankruptcy estate. So now all the attorney's fees have been paid and the IRS costs to do the VCP and all this other stuff has been done. There was a little bit of money left over, not very much, frankly, which could be imagined in a bankruptcy issue and so forth. So many, not all, but many of the housing authorities were sent a check from the bankruptcy estate to that, and many of the plan sponsors are putting the money in the plan. So that, and again, if indeed that happens, that will happen in probably the first quarter. That will show up on your statement that you'll receive in the second quarter. So I just wanted to explain here, it is merely a coincidence that this is happening at the same time, and that deposit, excuse me, that check from the bankruptcy estate has absolutely nothing to do with the VCP information. Okay, next slide, Trey. Now, let's assume this is all done, whatever the things I've been talking about so far. One of the things, of course, I've been talking about since acquiring your plan as a client in the last 3 years is to go around and say, okay, you know, we're not life associates, never was, and we have been doing this for a number of years, and to basically fix, in some respects, things that have been done in your plan, not that they were evil or incorrect necessarily, but just bringing them up to snuff, if you will, with the 21st century. And so what these bullet points, these boxes here, are simply to explain, and I'm going to touch on it very briefly. If you have a specific question, of course, you can submit it and I'll address it, but just to give you a little more background about us, if you're not already familiar with us, I started the firm 32 years ago. Me, myself, and my wife, and we now have 20 employees, including my 2 sons, are in the business and so forth, and we administer about 500 plans in 34 states. In retirement plan world, it's federal rules, so the state borders don't really mean anything and so forth. So needless to say, I travel a lot, but again, we have plans around and been doing it for quite a while. I'm also a certified fiduciary by DALBAR. Most of you, or some of you, might be familiar with DALBAR. It's simply a rating agency and so forth, and there's an actual website. You could actually go to it and review it and so forth. But again, they do a background check. We have to do certain requirements to be certified on their list and so forth. A big change here in the upper right of this particular slide is, up to now, you have had, and this is just a limitation imposed by Life Associates, 27 principal funds and then the fixed account. Now, we're going to keep the fixed account because it's very popular, but we're going to, and I shall talk about that here a little bit down in the bottom of this slide, but the question is which 27 funds or 12 or 50, whatever the number happens to be, who's going to decide that? And we are going to be bringing in an actual what's called a 338 investment manager, and that's just a term of art and so forth. But they are going to take over the fiduciary responsibilities for determining your lineup, and they will then on a quarterly basis value them, or compare them rather, with their peer group. So all, large cap growth funds get compared with other large cap growth funds. All bond funds, short-term bond funds are compared with other short-term bond funds and so forth, and then change them as as prudent and so forth. And I'll talk more about that here in a second. Matrix Trust Company will be the custodian and actually hold the assets physically and be the plan's trustee and so forth. There was a corporate trustee years ago. They resigned during the bankruptcy time and so forth, and now we're going to be having for you a corporate trustee, again, another fiduciary to add a layer of protection so these things that occurred, especially relative to Life Associates time, will not happen again. The group term life insurance, and again, that's already in place. It's already there, but I just wanted to mention that we're going to continue to maintain that. We've also added, and for a number of our clients have already taken advantage of it, our one-on-one on-site employee education by David Franco, who is an licensed investment individual who comes and actually does the one-on-one meetings as well as group meetings to actually talk about not just the retirement plan, but also other assets that you might be saving for retirement, to get a better idea of where you are personally on your financial issues. There again is the guaranteed investment account. And then finally, which comes back to the 338 manager, is that you will not be limited to just 27 funds from Principal, because Principal is a good fund group, but so is American Funds, so is Vanguard, so is Fidelity, so are many others. And no one fund family, even American Funds or Fidelity or any of those, have all the best funds all the time, which is the necessity for someone to review these funds on a quarterly basis to replace them as time may go on. And we use open architecture. What's that mean? That means if there's 20,000 legally available mutual funds, which there are, that will be the pool from which Iron Financial will choose. Now, there will probably only be 10 to 15 to 20 fund choices in your plan because, again, how many large cap growth funds do you need? And the answer is you only need one. That may need to be replaced from time to time, but duplicating the same type of fund, buying the same assets, just through a different firm and so forth. So usually between 10 and 15 or 10 and 20, you're covering all the asset categories from conservative to aggressive. So they will be handling that. And again, we'll be bringing out all the institutional funds, which are less expensive in most cases, not all of the cases, but some of the funds there at Principal are more expensive, and these will be less expensive. So again, I wanted just to mention that will get implemented in time as we get through the VCP, as we get through these adjustments and all that stuff. That has to get done and balanced before we can institute all of these fiduciary oversight programs. Next slide, please, Trey. So what to look for? If you have not already received your fourth quarter 2016 statement, it's going to show a minus dollar amount. And again, it's just going to show VCP adjustment. Now, there's actually a 50-word, we'll say, footnote there that tries to describe this in a little more detail. We've prominently displayed it so that people don't miss it and so forth. But clearly, it's a negative number, so it's going to look like a fee. And so we want to be able to reiterate with all participants as to why this is happening and so forth. And again, questions obviously submitted. We're going to go to questions here in just a second, but I do want to refer you to, again, to that billingsco.com/Victor Charlie Paul, VCP, page, because it's going to have a recorded, have this particular webcast recorded. There's also frequently asked questions, some facts that are there, as well as a little more text in terms of how we got to where we are today. So with that, I think, Trey, let's start addressing some of the questions.
Okay, thank you. There was one question submitted through that micro website that you just mentioned. It says, why did some public housing authorities receive funds from this settlement from Life Associates?
Oh, good question. Now, again, that goes back to, let's go back a couple of slides, if you would, please, Trey. At least two, maybe three. Right there. Oh, went too far. All right, so again, that goes back to this recent check from the bankruptcy estate. Just be aware that the bankruptcy estate, it went into bankruptcy, I believe, in May of 2010. It was in 2010 anyway, and so forth. And some of these claims that were filed back then were claims that occurred in the early 2000s. Okay. So first of all, and then there were claimants that came on board between 2010 and 2016. So therefore, when checks went out, now again, there were other claimants, or creditors rather, in addition to the housing authorities and so forth. And so depending upon, you know, the level of security in terms of, you know, if you had a building with a mortgage, I mean, there's a different ordering in bankruptcy law in terms of who gets paid first, second, third, and so forth. Now, this last check that came out, which I alluded to earlier, it was basically the residual, whatever's left over. And again, I'm not privy, I'm not a party to the bankruptcy estate, so I don't know for sure that every housing authority got a check. My presumption would be the answer is no, because I know that that residual came back from bankruptcy filings that were made way back in 2010, and my experience with working with bankruptcies is, you know, you have creditors coming on board or filing a claim, let's just say in 2011, not that they're not a creditor, but they're not entitled to the same stuff of those that were maybe done previously. So did that address the question, Trey?
I think so. Again, I think that one was submitted through the website, so it may even be from someone who isn't on the call today. But I think that was a good explanation. One other question, what if others can't attend today's WebEx?
Good question. Right. This will be recorded, and so again, if you go to the Billings Co, or www, billingsco.com, so billings with a co.com /Victor Charlie Paul, VCP, then you'll have a link, a hyperlink that you can click, and this is recorded. So again, I especially encourage you, if you think it's of value to have your colleagues listen to it, certainly I certainly encourage you to pass on that information.
We should have it out on the website shortly after the call today. That appears to be no new questions here.
All right. Well, again, going back to the comment is that, you know, I've been in business now for 32 years. this has been what's called a group submission, so it's kind of a big deal with the IRS, but I have worked with retirement plans a long, long time. They are very complicated, and even though this was done on a mass basis for all the clients of Life Associates, this unfortunately happens more often than it should. And so forth. And again, going back to the slide that you can see now, that's part of the normal process that we see called best practices to make sure that if one of these entities, ourselves included, if one of these entities makes an error, either intentionally or otherwise, is that there are other layers of accountability that will catch it. Now, again, even in our own internal processes, we, have ways to oversee or to if you will, catch problems before they rise to the surface and so forth. But even if we do not do that, by having an independent trustee, by having an independent custodian, by having an independent fiduciary manager in the investments, I mean, they're looking, if you will, not at exactly the same records, but they're looking at your account just like we are and so forth, and so it's much less likely for that to occur. And so unfortunately, for better or worse, obviously worse, in the case of Life Associates, that was just stuff that they just didn't do. Any more questions that have come through,
yes.
Trey?
Actually, a few more have rolled in. Will there be any more fees or adjustments taken from my account to fix the issue?
No.
All right. Another question, why would I want to stay with Billings Company with all that has happened?
Well, my hope would be is you don't shoot the messenger. Okay. Our certainly desire, as well as obviously our legal obligation in the purchase agreement, was to cooperate with fixing the issue. So whatever the fix is, okay, has been, will be, whatever, and so forth, was simply negotiated between a gal named Karen Brandon, who was an attorney in Chicago who was hired by the bankruptcy estate, was negotiated between herself, her firm, and the IRS. We had no say-so in it, and so forth. Now, I wouldn't say I didn't give my input, but legally that was negotiated between them. So the reason, hopefully, that clients would stay with us is to say, well, hey, these guys have done this for a while, and by looking at this slide here, they are implementing the normal best practices things that have occurred. And again, picking the very last slide, it was very common probably back, well, I can tell you, back, I wasn't around, in the 50s and 60s and so forth, that if you wanted principal funds, you had to go to principal. Or if you wanted New York Life funds, you went to New York Life or Fidelity. I mean, again, but the industry has been deregulated, so basically no matter what investment company you go to, you might have a New York Life agent who is your financial advisor, but he or she is selling mutual funds from virtually every other company that's out there. And so forth. And so again, there's nothing evil about having just principal funds, but it's not a best practices method because principal, good company, doesn't have all the good best investment managers all the time, and no fund family does, and so forth. So again, what we're trying to do, and hopefully, of course, you're going to compare us, you should, in due diligence to say, okay, if you went across the street, do they have an independent custodian? Okay. Do they have an independent plan trustee? Do they offer group term life insurance through their plan accounts? Do they offer open architecture? I mean, those are the things that you as a participant collectively through your plan sponsor is going to say, okay, we want to bring the best that we can to our employees or to our participants, and hopefully these issues that we're talking about here on this slide will do that. So certainly we hope that people will stay. Certainly I'm aware, I came in the picture in 2014, and I looked at the list of all the plan sponsors, a number of them, probably 20%, who had issued notices saying they want to leave. They all happened right about the same time when all the turmoil was going on and immediately prior to the time that the trustee took over. So obviously the plan sponsor was reacting, as well they should, as a fiduciary, reacting to the individual situation. Well, okay, that's perfectly reasonable and so forth. But of course, what we've tried to do since then, given the limitations we had in going with the IRS and so forth, to bring you around and, if you will, bring the account up to the 21st century. And again, certainly any plan sponsor is going to look at these slides here and then say, okay, Billings says he's got a pretty good package. Well, let's find out if he knows what he's talking about. You're going to go across the street and see what they do.
Okay. Kind of a housekeeping, there's another webcast later today. Do I need to attend both webcasts today?
No, they will be identical. Obviously, there may be some different questions, but they'll be exact same slides.
Okay. Looks like that is all the questions.
Okay. Now, certainly, if you think of something or someone else occurs to have a question, certainly you can submit it obviously on the webcast later today, but you can also email us either to Carrie Zachman, your account manager, or to myself and so forth, or and I'll give you my phone number, our phone number, just in case you don't have that. It's 1-800-713-4015, and Carrie's direct extension is 3020. So again, 800-713-4015. Carrie's extension is 3020. And mine, I guess I'll give you that as well, is 3002. So Carrie's is 3020, and mine is 3002. So feel free, obviously, if we want to address any questions that you have. No more questions, Trey?
Nope, no more questions have come in, Dick.
Okay. Thank you all very much for your time today, and well, we look forward to answering any questions you may have. Have a great day.